Lemonade reported earnings last night and the stock went down massively, but it wasn't because of their earnings. Hello everyone, welcome back to the channel. Today we're gonna talk about Lemonade. As you know, it's one of my favorite companies that I've been investing since they went public last year. Their earnings report, we're gonna talk about their stock performance, analyze expectations and how they did last quarter. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Now, as you can see here, the stock was up 1.40% during the day yesterday, but it went down 5.11%. But it actually went down 7%. And that wasn't because of their earnings. That was because of this. Lemonade is acquiring Metromile, which we're going to talk about that later. But as you can see, the stock is down 0.79% in the past 6 months, and it's up 7.44% in the past year. But we know that the stock went down massively, 61% since its peak. But it was way necessary because here the stock was really overvalued. Now, the stock traded at $66.85 per share after hours, and we can see that their lowest point in the last 52 weeks, it's $55 per share with a market cap of $4.34 billion. Now, let's talk about this. Why Lemonade is acquiring Metromile. Metromile, as they said here, or Metromile describes itself as a data science company focused on auto insurance, which in my opinion, this is very good and you're going to see why, but still the stock dropped massively. And here is why. Shai Wigner, as we can see, this one of the founders of Lemonade, said that after they launched their own car insurance, they were stoked to be adding the Metromile team to the Lemonade family. Then they said that Metromile will bring 10 years of closed-loop telematics and machine learning models trained on 3 billion miles of driving data, and Metromile comes with more than 100 in force premium, about 100,000 loyal customers, and more than 250 million in cash. Now, this will, in my opinion, is incredible because, as Chai said here, Metromile is already licensed in 49 states and live in 8 states, including California. So this will certainly help Lemonade to expand way faster with this acquisition, as we know that they are not available in all 49 states with all of their products. They have at least one product in each state, but not all of their products yet. So this will help their auto insurance product to grow way faster and expand faster than expected, which will help them with their path to profitability and the growth of the company. I have to say that this is very interesting because Lemonade just launched their car insurance, and obviously all this data will help them accelerate the process of growth. As even he said here, that they will incorporate Metromile's precision pricing models into our existing car product to accelerate its path to profitability. So they know that by acquiring Metromile, it will help the company continue with the growth and their path to profitability. The thing is that the stock dropped mainly because of this. The insurance company powered by AI and social good and Metromile, the data science company focused on auto insurance, have entered into a definitive agreement pursuant to which Lemonade will acquire Metromile in an all-stock transaction that implies a fully diluted equity and of a value of approximately $500 million, or just over $200 million net of cash. Under the terms of transactions, Metromile shareholders will receive Lemonade common stock shares at a ratio of 19:1. So they will fully dilute their equity for a value of approximately $500 million. And we can see here that Metromile at the moment has a market cap of $400 million. Now, in my opinion, the stock went down because of the fully diluted equity. No one likes to be diluted in an investment, and they will dilute us because of this. Now, Lemonade reported earnings pretty late last night. As you can see, I was going to post this video yesterday, but they posted the reports really late. I was already asleep. So they reported a growth in in-force premiums of 84%. Premium per customer, 26%. Total customers, 45% to 1.3 million total customers. Now, this is without the Metromile customers that they will bring in, even though that is a complete different company. Now, their gross loss ratio did increase 5% year over year to 77%. And obviously that is not that good, as we like to see the loss ratio decreasing, but they explain why, and we're going to see that later. Then their gross earned premium increased 86%. Now, their growth, business mix, and bundling. In quarter 3 2021, we drove a record of 50 million sequential increase in in-force premium. This marks the third consecutive record quarter. They have been reporting excellent numbers in the past 3 quarters, and this was a consecutive record quarter for them. Now, with non-renters share of our overall book of business ticking up to 47%, our pet lines of businesses added 2% to its share, life share has increased 2%, and homeowner shares is stable at 30%. Their loss ratio was 77%, notwithstanding the fact that their newer products are demonstrating improving loss ratio. This is what I was talking at the beginning, that we'd like to see this loss ratio decreasing, but it increased to 77%. Still, renters comprising to 53% of the book, relative to 70% a year ago. Then their pet loss ratio improved by 4% points sequentially, while their homeowners' loss ratio improved 52% year over year. Their operating expenses increased in the following expenses line because of sales and marketing, as they started investing in advertising and employee-related expenses, in technology and development, increased employee-related expenses to support their continued growth and product development initiatives. Then general and administrative increased employee-related expenses and overhead costs to support their continued growth. Now, we can see here that they reported a revenue of $35.7 million, which obviously it's really good, because it was a growth of 101% year over year, while analysts were expecting for this company a growth of 87.50% with a revenue of $33.38 million. So they beat analysts' expectations, reporting $35.7 million in revenue. We know that they are ceding 75% of their premium to reinsurers, as we talked yesterday, which is why I've been waiting for this third quarter earnings report, as they started with reinsurers in the third quarter of 2020. So we were not comparing apple with apples in the revenue, we were comparing apple with bananas. So still, we can see that their expenses did increase 106% year over year, as I said before, because of their sales and marketing, technology and development, and general administrative. But obviously people don't like to see this, because they believe that with the growth that they've been having, the expenses could have been managed way better. But they have been investing a lot of money into their business to continue seeing that nice growth that we're seeing right now. Now, obviously, I want to see this improving in the coming quarters, but still, this 101% was a huge growth, way better than expected. Now, they do have $1.5 billion in total assets and only $473 million in total liabilities. So in my opinion, they have a pretty healthy balance sheet. Even though with a new acquisition that they will do, they are able to do that, even though they're going to do it with diluting their shares, but still they have $1.5 billion in total assets and only $805 million in total investments, and cash and cash equivalents and restricted cash of $319 million, which decreased since December 2020, but their total investments increased massively. Now we can see that their customers have been growing quarter over quarter and year over year since 2019, from 500,000 customers to 1.3 million customers, as well as the premium per customers. That's why the in-force premium has been growing that much year over year. As you can see, it grew 99% in 2020 and 84% in 2021. If this is not a good growth, I don't know what it is, because this earnings report was excellent in my opinion. Obviously with some things that they need to improve, like their expenses, but many other things that I liked. I liked the acquisition with Metromile. I understand that no one likes to be diluted, but we're gonna have more information in that later. Now for quarter 4 2021, they're expecting a revenue of $39 to $40 million, which analysts were expecting for this company $39 million in the next quarter. For the full year, they're expecting a revenue of $126 to $127 million, while analysts were expecting $124 million. So they're expecting way more than what analysts are expecting. Still, there is something that impressed me a lot is that, as we can see here, they had this huge drop when they started with the range shooters here in Q3 2020, and now today they were able to report, even with range shooters, a way higher revenue than what they were having in the Q2 2020 without range shooters. Now, you guys know that I have a position in this company at the moment, and even though the market is closed, it's trading at $66.89 per share, and I will put a screenshot here or here with my position, which is currently up 17.90% currently, and it only represents 3.40% of my portfolio, and have an average cost of $56.74 per share. I don't know if you guys remember, but this used to be a huge position in my portfolio, and I've been adding to other positions just like football that represents about 15% or 20% of my portfolio. That's why my portfolio diversity have decreased with this position, but it is getting to a price where I want to buy. I would like to buy below $60 per share, but I could buy at 65 as well, a little bit, not that much, as it already represents 3.40% of my portfolio, and I want it to be a 5% position in my portfolio. Now, I would like to know your thoughts on the Metromile acquisition and their earnings report. Leave me a comment down below what you think about that. I will leave you here my video with the stocks I will be watching this week that will be reporting earnings. Thank you, and see you next time.